Hello, chart watchers, and welcome to this Thursday, February 8th Market Watchers Live Show with your hosts, Tom Bowley and Aaron Swenlin. For those of you joining us for the first time today, welcome to the show. And to our regulars, welcome back. Very interesting day again in the market today. We have got a lot of downside action, as you can see from the charts here. You've got the Dow Jones Industrial Average currently down 375 points. The S&P 500 down 31, the NASDAQ down 87, and the Russell 2000 down 14 points. The 10-year Treasury yield, after moving up and nearly touching 2.90%, has pulled back over the past hour and a half, back near the unchanged level around 2.85%. Volatility back on the rise again, touching the 30 level earlier this morning before backing off just a bit. Several industry groups I thought I would mention here that really struggling today, or most of them struggling. First, we've got the Dow Jones U.S. Toys Index. This is a group that has very solid support around the 1020, 1030 area, but since reaching the 1090s yesterday, you can see it's been a pretty steady decline today as that group moves back down close to its rising 20-week moving average. Mobile telecommunications, the Dow Jones USWC here, DJUSWC, again, also having a pretty rough morning, trying to bounce off of recent lows. This is actually a group that peaked back in early 2018. Looked like it was starting to regain some momentum that had been lost in 2017, but has since lost about 10% since that peak in January. Then we've got the commercial vehicles and trucks, the DJUSHR, also having a rough morning this morning. It is actually testing critical 20-week EMA support. So this is going to be an interesting chart to watch, because this has been one of the better industry groups over the past several months, and the pullback could be presenting pretty nice opportunity. We've got investment services here falling back also. You can see many of these industry groups looking very similar, but there was a negative divergence on this particular chart on the daily chart, and that set up some weakness, and now we are moving back and testing the rising 20-week moving average. Dow Jones U.S. Tires Index, this is part of consumer staples, and you can see also having a rough day this morning. This is a group that opened with some strength in 2018, but it's really been consolidating for the last 3 years. We're seeing weakness today nonetheless. And then finally, tobacco. This is actually a group that's up today, but it has been down 15% since June of 2017. So not all areas have been in a bull market for sure. We are seeing a little bit of a bounce here in the tobacco group. With that, I'm going to bring in my co-host, Aaron. How are you doing this morning, Aaron?
I'm doing quite well today. How are you?
I am good. We have got a great show lined up today. We actually have a couple of friends of ours here on the show. Yes. So I'm going to bring in Arthur Hill and Greg Schnell. How are you guys doing today?
Very good.
Sweet.
Hello, gang. It's good to be here. It's been a while since we've all four been together.
That's true.
It has been a long time, actually. Yeah.
What's interesting here, this is technology at its finest. I'm on the East Coast. Aaron, of course, is on the southern West Coast. And then you've got Greg, you're actually visiting out in the Seattle office of Stock Charts. So you're up in the upper Northwest on the coast. And we've got Arthur Hill halfway around the world over in Belgium, I'm assuming. Is that correct, Arthur?
I am in Belgium, yes.
Wow.
Must be late.
It's dinner time. It's 6 o'clock in the evening.
Well, this is going to be an interesting show for sure, and we're going to bring both Arthur and Greg back in a few minutes, but I'm going to let Aaron jump into our announcements and our agenda for today.
All right. Sounds like a plan. All right. So for our weekly schedule, there's only one more day. So we have Tom's workshop tomorrow, and he's going to show you some of his tips and tricks and how he uses stock charts for his trading. So that should be a great show tomorrow. Today, as we said, jam-packed. We are going to start with Arthur Hill. He's going to talk about the VIX, among other things. And then we have Greg Schnell here. He's going to talk a little bit about his new book, Stock Charts for Dummies. And we have our 10 and 10. I'm still taking your symbols. So the first one's going to be Cryoport, CYRX, came in through email. And then we have Anatomy of a Trade. And I actually am going to go through one that didn't turn out so well. I don't know about you, Tom, but we can't always have good ones. So
I have a lot of those right now.
And then we do have ChartCon 2018 coming up, and the four of us will finally get to be back together again. And we'd love to have you there live, and you can be a VIP. That is closing like next week. So you need to get in there if you want to be a VIP and actually join us live instead of just online. We'd love to have you because, as you know, the four of us have a great time. The rest of us have a great time, and we would love to include you. So I hope that you consider that. And there's your link if you want to go to check it out.
I think there's like 15 speakers, so it's going to be fun. We are going to have a blast with that.
Oh, absolutely. And then, of course, if you want to really go all the way, you can take the cruise with us to Alaska the week after, right after ChartCon. So, and I know a lot of us are going on that, and I can't wait.
Absolutely. You know what? Anytime you get Greg Schnell in a room, it's nothing but laughs. Have you noticed that, Aaron?
Yes. I'll be doing
the last time I told my camping story, and that kind of had everybody rolling.
Oh,
yeah.
my goodness. That was the best. And you all can hear that story if you come to ChartCon and join us live. So it is a good one, I have to say, one of the better ones.
Well, I tell you what, we're going to do something a little different here today. I'm going to go into the technical news, but I'm going to kind of bring it to a little crescendo here. I'm going to talk about the VIX. I know Arthur's going to be talking about the VIX later in the show. I think this is going to be a really interesting show. But I want to go through the last few times the VIX has spiked and then take a look during those periods at the perf charts to see what sectors did what during the various pullbacks. I think you'll find it interesting. When I get to the end of it, I want to get Aaron's and Arthur's and Greg's comments as well. Just, you know, see if maybe you'll say, hey, it doesn't mean anything to me, or you might say, hey, that's pretty interesting stuff. But anyway, let me get into it here. So first things first, we do have one key economic report to discuss. And so you can see here is the 10-year Treasury yield. We had initial jobless claims out this morning. 221,000 was the reading. Market was expecting 235,000. So we did get a better than expected report. And so that was a good thing. And initially, you can see the 10-year Treasury yield did move higher. We got up as high as 2.884%, getting closer and closer to that 3% level. When we broke above 2.60, in my opinion, there wasn't a whole lot of resistance on the chart until we hit 3. So seems like the 10-year Treasury yield is heading for 3%. We'll see what happens from there. But what I wanted to do, and let me first, and I'm going to go ahead and set this chart up. You can kind of watch what I'm doing here. But let's first just go into the S&P 500. I'm going to switch this to let's switch it to a monthly chart. This was not let's try this again. So let's do an S&P monthly chart. I'm going to go back. Let's go back 20 years. I probably can only need to go back 10, but let's do 20. And I'm also going to bring up, I'm going to use price on the indicator window and pull up the VIX, and I'm going to make the height taller so we can kind of see it much better. But so here's the last 20 years. This is the S&P 500, and here's the VIX. And I want you to just take a look, and we talked about this recently with these spikes. So currently we're sitting at about 30, but we just hit 50 recently. And if I put this on candlesticks, which would be even better, so you can see the actual highs. You'll see that we did touch 50 earlier this week. We also had hit 50 back in 2015. 2011, we had a big move. And then, of course, back in 2007, before we got up to the 90, we really started picking up toward the end. So I wanted to look at different periods. So I picked the end of 2007, when we made that first big decline with a VIX that was already elevated up in the 30s. And then I looked at 2011, 2015, and I looked currently to see what's been transpiring or what transpired during these periods when the VIX went crazy. And, of course, the market sold off. So I'm going to start with, let me start with the oldest one first, 2007. Now, what I did is after getting into the perf chart, I had the S&P 500 with all the sectors going across. So you can see this is the performance of the S&P, and then this is the performance of the 4 aggressive sectors. Here's energy and materials, and then these were the 3 defensive areas, healthcare, consumer staples, and utilities. So in 2007, when we got that huge spike in the VIX, what we saw and this wasn't just a huge spike in the VIX, it also was a big sell-off in the S&P 500. You can see the S&P dropped over 20 days back from October 31st, 2007. And I can, make this a little larger so you can kind of see what I'm doing here. But October 31st, 2007 to November 28th, 2007. During that period, the S&P 500 fell 5.19%. Technology fell a little bit more, industrials a little less, consumer discretionary a little bit more, and financials got hit really hard. So 3 of the 4 aggressive groups sold off harder than the S&P 500, while the 3 defensive groups clearly saw money rotating into them. So again, this is back in 2007. We were in a bull market at the time. If you looked at the S&P 500 at the end of October 2007, you would have known not a whole lot different than what we were looking at 3 weeks ago, or well, actually 1 week ago when the market topped. You would be thinking, okay, we're in a bull market, we're near highs, everything's peachy. But during that first sell-off in 2007, I think you can see money rotating in a pretty big way towards defense. Now I'm going to fast forward to 2011 when we had that next really big spike in the VIX. And during this period from July 22nd to August 15th of 2011, the S&P 500 dropped 10.4%, 10.45%. And if you look, technology went down about 8%, industrials 13%, consumer discretionary 11%, and financials 14%. So they went down a little bit more, and money rotated a little bit more toward the defensive areas. But we were only 2 years removed from one of the nastiest bear markets of our time. Unless you lived through the Depression, this was probably the worst bear market that you've experienced. And so I think, for me anyway, looking back, 2011 was still fresh in everyone's mind. And as the market started to drop and the VIX shot up, I think there was a little bit of panic in the market, and folks were thinking, okay, we're going back into another deep decline. And so risky assets were thrown out the window, and money started rotating a little bit towards defense. Now let's fast forward to 2015. Now we're 6 years into the bull market. And in 2015, when we had that big drop and everybody says, here we go, we're heading lower again, I want you to take a look at these riskier areas, the aggressive sectors: technology, industrials, consumer discretionary, and financials. 3 of them actually have dropped less than the S&P 500. And notice the defensive stocks just kind of went along for the ride to the downside. So in other words, there was not this major shift during this sell-off that would make you think that we were preparing for something horrible. And as we know, history has shown us, the market bounced back from that. Now let's take a look at where we are today. And take a look at this last drop from January 26th to February 7th. We've seen the S&P 500 go down 6 2/3%. But notice all of the aggressive groups have actually gone down less than the S&P 500. And there's more selling taking place in defensive areas. Now, I'm going to open this up to the floor for the rest of you, Aaron and Arthur and Greg. But when I look at something like this, it doesn't make sense that we're topping for the long term if the money is not rotating into defensive areas. I would have expected, if we're calling a top here, I would personally expect that these aggressive areas would be dropping more during this decline, and that money would be rotating somewhat toward defense, and they would be declining less. But I'd like your thoughts. I mean, does this make any sense to you, or does it, tell me if you think it doesn't matter. But Aaron, why don't you go first? And just make sure you're not muted.
Oh, wake up, Aaron. No. Yeah, I was muted. I'm sorry. When I look at this, typically we do see that intermarket rotation. But to me, this has a little bit of worrisome thoughts to me in that we're not seeing rotation. We're seeing money maybe coming out of the market. And that concerns me. So rather than money moving and shifting around, you can see all of these are losing. And so that actually concerns me somewhat. But I do see your point, because we do want to start seeing, I'd like to see more money going in. But I think it is very strange, though. We're not getting that rotation, but that's kind of what worries me a little bit.
Yeah, I like that. I like to see defensive stocks outperforming. If I'm really going to become more bearish, I think money needs to rotate a little bit more. I mean, again, that's just my opinion. But Arthur, do you have any comments, any thoughts?
Yeah, I do. It's funny you should mention this 2007 period because I was thinking kind of, you're thinking, is this the bear market? And you think of prior bear markets and what kicked them off. And I'm just going to grab the screen so I can show you a chart from 2007.
Sure.
All right, so, whoops, now we got the wrong one.
Command tab.
Yeah, nothing like doing stuff live, huh?
Mm-hmm.
Well, anyhow, the chart I was going to show, and if I can get it back up, but basically in 2007, you had the S&P hitting a high, as you showed, Tom, that the S&P hit its high in October. But if you go back, you can see that financials peaked back in May, so a few months before the S&P did, and the equal weight consumer discretionary ETF or sector peaked in June. So you had two very important sectors already heading down a month or 1 to 3 months before the S&P 500 started heading down. And that didn't happen this time. I mean, you had multiple new highs in multiple offensive sectors in January. Yeah, we were overextended, and yeah, we could pull back to the 200-day for the S&P 500. But I don't think, we're on the cusp of a bear market, so to speak.
Yeah, I just went back. I actually grabbed the screen here, and I wanted to highlight what Arthur was just talking about here. This was the XLY back in 2007. So you can see the peak in the XLY actually occurred in the first half of the year. And if you recall, the S&P, well, I can pull it up, but the S&P 500 actually topped in the second half of 2007. So the point here is that money began rotating away from the consumer discretionary sector back in the early part of 2007. And if we pull up the financials that Arthur was referring to as well, you can see the same thing, that we peaked in the first half. So money was beginning to rotate away from both of those very influential parts of the market before the S&P 500 topped. And of course, if you're listening to CNBC, all you're going to be hearing is the cheerleading, we're moving on to new highs, but really underneath the surface of the market, I think, Arthur, you're making a really valid point that money was rotating. And that was kind of the point I was looking at on these other charts. And again, that's why when I look at 2007, and this was starting in October of 2007, you can see that the money was definitely shifting away from the aggressive areas and clearly moving into the defensive areas. But when we fast forward to what we're seeing right now, it's a completely different picture. And so for me, and this is one of the reasons why I still remain bullish, and I think that this is a pullback in a longer term trend, and you all may agree or disagree with me, but that was kind of my point with that.
Right.
Absolutely.
Yeah, I agree. I did get an email about when we did our agree disagree as far as whether we're looking at a bear market or not. And I kind of took devil's advocate position that this could be, the beginning of a bear market. But I want to say that was for the exercise. I'm not like, oh yes, this is the next bear market. I don't feel that way. I don't. I'm a little concerned that we continue to keep correcting backwards. We're not seeing a lot of, like I said, money's leaving. That concerns me a bit.
Yeah, and I think, and I took the side that we are not entering a bear market, but that doesn't mean we're not. We certainly could be. Yeah. I think one of the signs would be if we start rallying again and the money rotates toward defense to lead that rally, I'd become a lot more concerned about the strength of the move to the upside. But we didn't get Greg's comments. I wanted to see, Greg, did you have any opinions on, some of the sector rotation we're talking about?
I never have an opinion. I'm pretty mellow guy. Okay, everybody got that joke. So I think the one thing that happened in 07, not that I want to compare everything to 07, but in 07, we hit highs in July. Then we pulled back all the way through to August. And it was on the October high that everything started to really show a lot of negative divergence. So what I would say is we've made a major high. We've pulled back. Normally pullbacks are 4 to 6 weeks. We're in the second week, so no big deal. But, you know, I would expect us to go retest the highs. And as we retest the highs, if we start to see technology fall away, or we start to see the financials fall away, or we start to see something, you know, from the major groups really start to break down, then I'd be more cautious. But I think right now, I mean, it was a parabolic move up. So you got to expect at some point, some institutional investors are going to say, I don't feel like putting any more money in here. And, anyway, I think we hit that spot, and so we'll probably, you know, shake out a little bit. I think the fall in energy, we've been talking about it on Commodities Countdown for a couple of weeks now. I think the headlines have been displaying that, and so we've seen the market start to bifurcate, where some of the stuff like utilities have been pulling back and energy pulling back and that kind of thing, but still the financials are in good shape and technology is in good shape. So I don't know that we've made any sort of major high, but the real point would be when we kind of have a test of it, let's say out in May or something. If that was to kind of correspond with the time frame, if in May we started to see a lot of divergence, then I'd be a lot more cautious. So I think it's important to watch the defensive sectors and just see how they start to behave. If they start to outperform here over the next couple of months, that would probably be a clue that something is shifting.
Yeah, and one last point, and I'll let Arthur get on with his presentation. But the thing that's interesting that I find about this huge spike in the VIX now, if we look back, 2015, it occurred in the summer months. 2011, it occurred in the summer months. And in 2007, of course, that particular period, we started to struggle. And I think you pointed out correctly, Greg, we started seeing a lot of negative divergences. And that started in the summer of 2007, even though the weakness, this actual sell-offs, began in the end of 2007 into 2008. But there were negative divergences, and I saw them across the board in a lot of different areas, not just comparing price action to, say, a PPO or a MACD or PMO or anything like that, but literally looking at divergences with the market moving up and discretionaries rolling over, financials rolling over, some of the relationships, the ratios that I like to follow. I like to follow the XLY versus the XLP. That completely started falling apart in 2006 into 2007. So there were a lot of those different divergences. But anyway, great discussion. I'm glad everybody had a chance to chime in, and I'm going to turn it over to Arthur for his discussion on the VIX.
Yeah, if anybody's contrarian, you can just ignore everything we said and do the opposite.
There you go.
That's probably the truest statement.
I mean, that's the scariest thing is, you know, everybody's in agreement. So then you have to like scratch your head a little bit.
Mm-hmm.
But okay, I'm going to try the screen grab again. And what I'm going to talk about today would be the regime change that I think we're undergoing in the VIX.
There you go.
And there you should have my screen. And we're going to do some guesstimating for support for the S&P 500. And we'll look at a couple past corrections, in particular the May flash crash, which I think best resembles what we just saw. And then we're going to revisit inflation from the last time I was on the Market Watchers show in December. So looking at the VIX, which seems to be the topic du jour today or this week, I'm going back basically to March 2009. All right, and this is a semi-log chart, so it's going to look a little bit different than, say, a log chart. This is a semi-log chart, so it's going to look different than an arithmetic chart. There's no way we're going to get into the log versus arithmetic chart debate today. But what I want to show is basically 4 different regimes for the VIX over this roughly 9-year period. You know, you had the first period here, 09, 10, 11, and 12. And you still had the hangover from 2007, 2008, when we had that big bear market. And then, of course, in 2010 here, you had the May flash crash. And there's the correction that we had down there at the bottom. That's the S&P 500. And then we had the European sovereign debt crisis, and the VIX spiked above 40. And we had a pretty sharp decline, and it took a few months to get a bottom in. And then we moved into what I would call the nice bull market range. You know, 2013 was the only thing better than 2013 was 2017, because this was a great steady bull market. And you can see these dips above, these surges above 20 offered opportunities then. So this was kind of like your market trending higher VIX, if you will. And then 2015 hit and we started getting volatility again. And if you look at the S&P 500 at the bottom, you know, we had a plunge, a test, a surge, another plunge, another test, and then we finally started higher in 2016 and onwards. And then the fourth volatility regime would be when we started declining here in 2016, and we remained low in 2017. And in 2017, a simple move above 15 was extreme on the VIX, and that's when you got your buy the dip opportunities. But I think that has changed with this surge that we've had in the VIX now. We're going to move into a new regime, and the question is, which regime is it going to be? And my guess is going to be something like this 2014 maybe, where you get a little bit higher than, you know, obviously we're already up near 30, but 20 is kind of like my level to watch. You know, when we move above 20, 25, then we're kind of in a dangerous area because fear is still running rampant and the VIX is high and the market is uncertain. And that's when you can get a lot of volatility, surprise, surprise. You can get a lot of choppy sideways action. You can get some pretty big swings, a couple percent in a couple days either way. And that's what we might be entering into now. Now, this second chart here kind of hones in on what we've seen over the past 5 years or so. And I've got green dashed lines there. And basically, when you go above 25, you've had some sort of spike in fear. And you need to let that spike subside, I think, for the market to get its confidence back and for a rally to take hold or to be sustainable. And so I look for a move back below 20. And you can see we had that happen here in October, and then we moved below 20, and we got a bounce. Now, it's not perfect. We got a pretty good bounce there in October 2015, but if you see here, we stayed above 20 for 6 weeks. So it took a while for the market to settle down. And even when it settled down, it didn't last long because the VIX came right back, or VIX went up and the S&P 500 went down. And you got a couple of signals there in the first quarter of 2016. And the second one proved good. The first one was early or wrong, take your pick. And then we got another one there at the end of June. And so now, as far as things are concerned, I'm looking for the VIX to move below 20 to suggest that the market has calmed down. Because, you know, if you look at the performance over the, for February, basically, almost everything is down. Oil, bonds, stocks, copper, gold. The only thing that was up would be the dollar, some soft commodities like corn and coffee, and that's about it. So something's out there that's the market is not happy with. So if we do have a little more volatility, where might we get support? And I'll be the first to admit, when I make a support estimate on a chart for the S&P 500, which has 500 moving parts, it is a guesstimate. All right, this is half part art, part science, technical analysis. And so I put some lines on here. I got some trend lines.
Hey, Arthur.
Yes.
I think this is 100% art.
Thank you.
Sorry.
It's true. It's 100% my opinion. But, you know, I've got a trend line here, and that kind of measures the rate of ascent because we got a semi-log scale here. So the steepness tells you the rate of ascent. And if we break that trend line, then we've changed the rate of ascent. But have we reversed the long-term trend? Well, I'm not so sure. But the level I'm really focused on is kind of this 2500, 2550 area, because you can see this rising 200-day moving average there. And, you know, the 200-day moving average it's not like there was buying pressure there before. Well, there was, but the reason I think it works for the S&P 500 is it's so widely followed. It's kind of like a self-fulfilling prophecy. If so many people use it, and I think that's very true for the S&P 500, you got to be in tune with it. And so I think this, like 2538 is where it's at now, is an area to watch for a potential reversal. And then I've got some Fibonacci numbers starting from the low in February 2016 and the low in June and the low in October and extending up to the recent high. You get a cluster of 3 Fibonacci numbers there around 2,500. Now this is really art. All right, looking for the cluster here. And then you've got kind of a consolidation zone here that might be some support. But, at the end of the day, I think that rising 200-day is kind of as good as any as far as, a correction target and a place to look if you want to put some money to work on the falling knife. So let's look at a couple of corrections over the last few years, because, sometimes it takes a while for the market to regain its footing, because it's like the prize fighter, that got cold cocked and knocked to the ground. He can stand up after a 5 or 6 count, but it's going to be a little bit wobbly. And so this chart shows the run from 2009 all the way to now. And I'm hesitant to call it entire bull market because this doesn't look like a bull market right here. You had kind of 9 months of hell in 2015. You definitely had bull market from the early part of 2016. But if you look here, this is the May flash crash on the left. And we were down like 10%. There's the zigzag indicator below. That was a 10% decline. And then we had a 10% bounce. And then another 10% decline. And so it took about 3 months to get our footing and start back up. And then we had another correction, depending on where you started. It could be 3 to 5 months. But we had a couple of lows there that we needed to test. And the similar thing here, we had a couple of lows we needed to test. So there was a bottoming process there after the shock, to get stability. And then if you look at 2015, we look like we had a bottom here, but we had another hit. And it looked like we were breaking below this low, but rallied back, and then that next bull leg started. So as long as the VIX is remaining above 20, we may need some time to get some stability back in the market. And this is just showing the 10-day rate of change. And you can see these dips below 5% in 2 weeks. And I think Erin will post that chart to the Market Watchers message when she puts it out if you want to see it.
Yeah,
and then finally, yeah,
absolutely. I'll get that out there.
And then finally, just want to review a chart from December 13th, because we've got a definite uptick in inflation since then. And that probably explains why bonds are just taking it on the chin. So this first chart shows the tips, and it's unadjusted, no distributions or payouts, and that's why it looks flat. And then this is the normal tips with the dividends, distributions added back in. So as long as you're getting your distributions, you were making more money. But without distributions, you weren't. And then I've got 3 ratios that I use to kind of measure inflationary pressures. And the first, the lower 2 had already broken out in the summer, the tip IEI ratio, which is the tips bond ETF relative to the 3 to 7 year Treasury bond ETF. So it started turning up. Tips were outperforming. And then tips started performing the 7 to 10 year. It's kind of like the belly of the yield curve. This is the short end of the yield curve. And now tips are outperforming TLT, the long end of the yield curve. So tips are outperforming everything. And tips, of course, are inflation hedged bonds. And so it's normal that they would outperform if inflationary pressures are perking up. So even though, TLT is way oversold, but I think it's oversold within a bear market. We're in a bear market in bonds now. And so, TLT might get an oversold bounce, but, I'd watch for that overbought level to look for a top then. So that kind of runs the gambit on the charts I had for today. I'll see if there's any questions coming in.
Yeah, very interesting presentation there, Arthur. And I would just say, maybe paraphrasing some of what you were talking about. I mean, at this point, this is a game changer in the sense that, we've seen, and I'm talking about the VIX in particular, but, we had been in a market for quite some time where we didn't have a pullback. I forget the number of days, but I think we had gone, I don't know if it was a year and a half or something like that, 500, 700 days without a 3% pullback on the S&P 500. And
yeah, it was like 300 and something days.
Yeah, so over a year. So, yeah, I mean, that's a long time to go without any kind of a pullback. And the mentality when you're in that is that the market will never pull back. And then all of a sudden now we got this game changer that you've identified with this huge move up in the VIX. And I think what it's telling us is that all of a sudden volatility, which we didn't see any of, is likely to be here with us for a while now. And it completely changes, I guess, how you approach the market, how you trade, how you place your stops and everything else. I mean, I guess a follow-up question for you, if you don't mind me asking, how's this changing the way you trade the market now?
Well, it's the pullback that was being waited for, that we were waiting for. And, the problem with pullbacks is they don't feel good when they happen. And everybody says when the market's high, oh, I'm going to buy the pullback. But when the pullback gets here, you don't feel so comfortable to get into the market. It gets hard to get into the market. But I'm going to keep the powder dry until we get some signs that the pullback is ending. And I think you have to turn to the S&P 500 and the broader market to determine that, because no matter what stock or equity related ETF you have, it's going to be under the shadow of the broader market until the broader market gets on a firm footing. I would hold off on putting money to work in anything stock related.
Yeah, and cash is a position. I mean, that is a choice sometimes. It's not always whether you're going to buy or sell short. Sometimes you can just, when the volatility picks up and the risk is a lot greater, one very good choice is just to simply sit in cash and kind of wait things out until things settle down.
Absolutely. Cash reduces your risk because you're not exposed to the market. So raising cash is a definite, strategy.
Absolutely.
I was looking at this chart here before we got started and just doing some measurements from that March low. You had a 100% move up to that 2011 high. And then we had another, I'm sure the Elliott waivers are going to be watching this. We had another 100% move from the low there. And then this move has been about 60%.
Mm-hmm.
So there's nothing analytical there, but it's just kind of like FYI.
Mm-hmm. Well, no doubt about it. Yeah, I think when you're looking at the market and, I always say it's like putting a puzzle together. It's not just about what the S&P 500 is doing. It's not just about what the VIX is doing. It's not just about what all the different sectors are doing. It's not just about what bonds are doing. It's not just about what's going on overseas. It's really about all of that and relationships and so forth. And so I always, I pay a lot of attention to a lot of John Murphy's work, where he's done a lot of the intermarket relationships and so forth. And to try to kind of gauge what's taking place under the surface of the market, rather than just look at what the S&P did yesterday or last week, but also, what are the dynamics that are changing? And I think your presentation certainly brings up one, and that is that now we are in a market environment with a lot more expected volatility. And I mean, we see it today. I mean, as you were going through your spiel, I think we were dropping about 50 points after, while you were doing each chart on the Dow Jones, which is currently down over 500 points, by the way. So we're continuing to see this volatility, and I completely agree with you. I think this is here to stay now for a little while until the market settles down.
Yeah, somebody was asking about a P&F chart, because that kind of filters out some of the day-to-day noise depending on your settings. But if you look at this P&F chart, 2,500 maybe, looks like the first support level, that broken resistance. A lot of consolidation there. That's a little bit lower than my target, but there you go.
Yeah, I thought that was kind of where you had the where that cluster. And by the way, I thought that was an interesting chart with the Fibonacci's, because one of the problems I have looking at Fibonacci sometimes is which bottom to use. And I think the way you did that by using various bottoms to where we went and using the cluster, I thought was really interesting. I hadn't seen that before.
Yeah, I kind of look for more than, well, you've said this before, you look for more than one indication.
Right.
To kind of confirm what you're looking for.
Awesome.
So.
All right. Well, are you going to hang around with us, or do you need to run? What's your schedule?
I'm going to go get dinner. It's
That's awesome. Well,
it's Taco Thursday here in Belgium.
Taco Thursday.
Hey, Art, before you leave, we just have to say we look forward to catching up to you at ChartCon. It's going to be awesome. So thanks for the presentation this morning. But yeah, it'll be nice to get together and share some stories. So look forward to that.
Absolutely. Looking forward to seeing everybody at ChartCon and also interacting with everybody. We have a wonderful app that you can send questions in through at ChartCon. And so we're always addressing those questions that you're sending in on the app. So definitely should be a good one.
Absolutely. Well, thank you so much for stopping by today, Arthur. I know everybody enjoyed it.
Guys. Have a good day.
Yep. Look forward to talking to you again soon. There he goes. All right. So now we've got up Mr. Schnell. And I tell you what, I know you've been really busy for the past few months, because every time I try to talk to you, you don't want to talk to me. I'm kidding. But, you have been very busy, I know, with your book. So why don't you go through this with everybody and let everybody know what you've been up to?
Okay, so just to give everybody a backdrop. So about a year ago, we started to talk about a book, and the co-author that I wrote this book with, Lita, has written about 40 of the Dummies series books. And so she's quite experienced, but she looks for authors to kind of help partner with. And so when I was approached to write a book, the idea was, what do you want to write about? And I think one of the big things that, I've read a few of the For Dummies books, but I'm pretty good at buying them, reading a couple of chapters, and actually not reading the whole book. What I found out was that the whole For Dummies style is exactly that they don't want people to have to read the book end to end. It should be something that you can pick up, learn a little bit about in the area that you want to find out more, and then maybe put the book away for reference later. So when I wrote the book, and it actually just, it's interesting, they give you a 50-page manual on how to write the book in that format. So it was a book about a book. But in the discussion, as you write the book, what you end up doing is writing an outline, and then taking that outline, pasting it into a Word document, and then filling out the document. Worked out really, really well, because for those of you that have followed my commodities countdown and stuff, once I get going down a path, I can go down that for a while. And this whole kind of, okay, what are we going to address in each chapter, and work through it, worked out pretty nice. So in the book itself, just so everybody knows, it's all stock charts. It's all stock charts, setups, but I talk about why to use candlestick charts, why you might want to use line charts, bar charts, mountain charts like you'd see on the business news networks and those kind of channels. So a lot of it is about the settings in stock charts and how to make great charts, not just here's a new trading idea. There's about 1,000 of those books out there. This is actually a book about building your base, understanding how to make the chart display the information you want, all of the little trick settings. A lot of people don't know what the extra bar setting is, and small things like that are buried in there. I think it came out pretty well. So anyway, I was in Scottsdale last week, and I'm talking to a group of people, and they're like, Greg, I'm having problems with this one part of stock charts. And I'm like, okay, well, that's in the book. The book isn't out yet. Why don't we get together and chat? And, they're professional portfolio managers, but everybody gets comfortable using the tools that they use and don't really get a chance to see some other settings. So in the book, what I try to do is show how to get things set up, maybe specifically about overlays and indicators, how to turn them on, how to change the settings, how to make them show up the way you want them to. And so if you're struggling with any of the sort of chart settings, that's an important part. I talk quite extensively about relative strength in the book. There's a whole chapter dedicated to that. What does that mean? Why is it important? How to display relative strength? How many different ways are there to display relative strength? And work through to kind of clarify that issue. So I think relative strength is one of the most important areas of the market. And somebody says, well, buy strong stocks. Okay, what's a strong stock? And there's a page in the book that shows two charts look identical. One chart's up from bottom to top 22%. One chart's 88%. And the difference is that the chart software stretches the data to fill the height of the chart. And so you can have a chart barely moving, but the only thing that it'll go bottom left to top right, but it might have only changed a couple of dollars, where you can have something, like an NVIDIA that's up $100, and the charts will look the same until you zero in on the scale. So I talk a lot about that type of thing, how to understand the difference in chart settings, how to make that information more obvious, and try to get that information together. So I'm not going to take a lot of time, but on Saturday, I'm doing the market outlook with Zach, and we're going to field questions. So feel free to flood them to me, gregs@stockcharts.com, stuff you'd like to talk about. So on Market Outlook, as I usually do, I'll do the weekly charts, and then that'll be kind of 20, 30 minutes. And then the back half of Saturday will be specifically talking about the questions you have, and maybe a Q&A on using stock charts, the platform, a little bit like Chip used to do in the old days when he had his Saturday webinars. So we'll be doing that. What happened was Stock Charts ordered 1,000 of these books. And so I'm sitting here beside a pretty big pile, and we've had a lot of pre-orders that have come in. But what I'd like to do is the Stock Charts books are $15 at Stock Charts. They're $26 on Amazon. So if you're interested, feel free to order the book. If you order it today, and I'm not trying to pressure you, but if you order it today, I'm sitting in Seattle, so I can put your name in the book and I can write a comment to you. Rayson ordered a book yesterday, and we've seen her on the chat. We've seen the name on the chat room. The point is that if you wanted it personalized, I can do it today. I can't do it after today because the books are here and I'm not usually in Seattle. So anyway, if that's special to you, you could do that. If not, you can order the books later. I've written in 1,000 copies. I've got about 500 done. I got 500 more to go. But if you'd like, I'd be happy to send that to you. And thanks for following my work, Stock Charts Works. Thanks, Tom and Aaron, for allowing me on the show today. But I'll be doing Commodities Countdown tonight. I'll be doing Market Outlook on the weekend. I'll be doing a presentation to the Ottawa CSTA chapter on Tuesday or Wednesday night. That will be a relative strength presentation, and I'll be presenting in Scottsdale on March the 7th to the MTA Association. So if any of those are interesting to you, I'd be happy to have you join me. Send me an email, gregs@stockcharts.com, if you need more information, and I'll get you in touch with the data. With that, thanks everybody, and I'll flip it back over to Tom and Aaron, and they can start to work through the 10 and 10.
All right.
Thanks, Greg, for coming by, and Aaron is kind of showing everyone how you can order the book and also the blog that Greg routinely writes. Also, if you want, go into the webinars, Aaron, and show everyone how they can go to that Stock Charts Outlook webinar, which is this Saturday. It's always a fun one. The market's closed, so you can kind of sit back and relax a little bit, a little different than a live show that we do here during the market every day. But you just go in there and you can register for the event. And it would be another great webinar put on by Greg, I'm sure. But I know you've been working really hard on the book, and I do want to say congratulations. I know it's a big task. You started a long time ago, and I know you feel a sense of accomplishment, Greg, getting that.
Yeah, it was kind of fun. I got to the Stock Charts office yesterday, and they had 1,000 books, but I'd never seen one. So it was interesting. Got here and kind of cracked open the box and took a look at the book with everybody around, and they took a picture of me opening my own book. So it was kind of interesting. Anyway, just it's kind of a road I hadn't ever gone down before. So that was fun.
I want you to sign one for me.
Okay.
I know. Do we get to have a complimentary copy sent to us?
Sure. All my love, Tom. Yes.
Let's not be fictitious, putting anything fictitious on there.
Maybe it'll be to more debates in the future.
Somebody wanted to know what the return policy was.
Well, if you need to return it, I've done something wrong, but we'll see. So, thanks, everybody.
All right, thanks.
Put the pressure on me. I've got all my notes to write a book, and I just haven't sat down and done it. So,
yeah, that's just so much time. I know how much time Greg puts into that. I mean, I've put together webinars, all day webinars before, and just doing that, it's just a tremendous amount of time. So I can't imagine sitting down and actually writing a book. I've had a lot of folks ask me to, but I don't know if I can do it. I don't know if I can.
Since we started the show, a lot of things ended up on my back burner because I want to give everybody the best of me for this show in the morning. So
there you go. And speaking of the best of us, we got to move on to the 10 and 10.
Indeed. Let's see.
Interesting one with the market continuing to sell off. Got the S&P now down 54 points.
Oh, absolutely. I'm going to go over to, let's see. I want to share some of the selections we had. I haven't entered them all, so I can actually show you how to do that. All right, so these are ones we had so far, and I'm going to add the last couple that I had in here, and I think that was... oh no, I think I got all the way through FCX. So AWK, OMC, GAJSO, ENBL, and EWJ. And I can just add them that quickly. And now so we have about 19. So if yours doesn't get selected, I'm sorry. So here, let's look at the RRG real quick and see what we got going. It's always very interesting to see what you guys request and where they're going. Are they strong? Are they weak? And we usually, if you notice, we get a pretty good mix. I always like to see what's going on with the leading category. So I'm definitely going to pick those three. But with that, I'm going to pass it along. And you've got Cryoport, CYRX, first and foremost.
All right. What was it?
CYRX.
Okay, let's take a look. All right. Well, first thing kind of stands out is we're just going sideways here and have been. We did have a couple of months there, though, where we were sideways consolidating, and that seems to be breaking down at this point. So I would be drawing, you can see how the resistance has been pretty tough between 9 and 9.25. But recently we had some pretty nice lows, or support that was holding on these lows at about 8, just a little bit above 8. But we broke that on a little bit of a pickup in volume here, I would say, a few days ago. And we haven't been able to close back above it, and now we're moving to a new low. I think we've got some gap support. So in the short term, maybe you go to the bottom of gap support closer to 750. It would seem like this is heading back to at least the 750 level. But honestly, I don't like the fact that this is a stock that hasn't performed well while the market's been going up. This gets back to Greg's earlier point about relative strength. This is, I'm trying to outperform the market. Do I want to try to get into a stock that hasn't been performing as well as the S&P 500? Probably not, unless there's something about the industry where it's just breaking out or something like that. But CYRX just doesn't look like a very good stock to me. So I think for me, I would avoid it, look for something else.
All right. Let's see. Number 2 is going to be AM, Antero Midstream Partners.
AM.
Mm-hmm.
All right. Yep. I mean, along with the market, obviously breaking down. I tell you what, some of these charts, I'm going to look at the weekly chart because the daily charts really don't look good. And some of them have negative divergences. This one does not. It actually, I would have expected it to hold that rising 20-day moving average, and it didn't. But there are many charts, many stocks, industry groups that do have negative divergences. But I would be looking for 20-week moving averages to hold, and that is not holding as well. So I think that the trading range from a longer-term perspective that is in play right now, clearly the high is up around 34. I think the recent low around 26. And we're currently trading at 28.54, and we are trending lower. So this is another one that for me, we had a nice little rally, but look at the weekly PPO, got up to the center line, started to roll back over again. This is one I think I would probably hold off on, and I'd just be watching.
Okay. Let's see. Number 3 will be OMC. OMC.
All right, OMC, so far, we did, you can see all the troubles that it was having getting back up through the 20-week moving average. So let me just kind of highlight the arrows. You can see once we fell apart with some pretty big volume back in July, you can look at these tests, and you can see the failures to get back through the 20-week. We started to here, though, and off this bottom, it looks to me like a left shoulder, neckline, head, right side of a neckline, and then a right shoulder that we broke out from, and now we're coming back down and testing it. So I think at this point you've got some neckline support just at about 74, a little bit over 74, and then you've got the rising 20-week moving average, which is currently at 74.09. So I think the combination in here is an area that I would watch really closely. I think if you close on a weekly basis back below that 20-week moving average, I'd be careful with OMC.
Okay. Let's see. Number 4 will be, let's make it AWK, American Waterworks. I always think of that Parker Brothers card game, Waterworks. I don't know if anybody ever played that. Great game.
Yeah, this one is starting to bother me a little bit because it's not holding on to the price support. And it also failed at the 20 after breaking below the 20-week moving average. I mean, we had a nice little cup here handle, and then we broke out, although the volume was a little suspect. So for pattern measurements, I like to see heavy volume confirm the breakout. But we did get up to about 91, 92, and then rolled back over, went back to the price support area, also that 50-week moving average, and now we've broken down below both of them. And the volume, we still got another day. Today's only Thursday. We got another day to go, and the volume seems to be picking up on this selling. So I'm a little concerned about this one until it can right the ship and move back up above, say, I'm going to say right around that 81. What's that 50-week moving average? 81 and 23. So let's call it 81 and a quarter. If we can get back up above that level, I'd maybe consider it. But as long as it's below, and you can see the failure of the 20-week moving average, let me highlight that. But that right there, if they're going below the 20, testing it, failing it, and then moving to a new low and taking out price support, this looks a little bit bearish to me. I'd look elsewhere.
Okay. Let's see. What's the next one? Did we do OMC yet?
Yes.
Okay. I know. I'm trying to get my... let's do Target, TGT.
All right. Well, I think the price resistance area is pretty clear looking at this 3-year weekly chart. Let's just put this right across the top there. I think you'll see $78 is a pretty solid wall of resistance, price resistance for Target. So I think that clearly is the upside. To the downside, we've got a nice rally going, and with the exception of 1 week, really the last 7 or 8 months, we've been holding above that rising 20-week moving average. We got close to it earlier this week, but we have reversed back to the upside. We're closer to the high of the week than we are the low, which I think shows some relative strength. But I'd be watching this 20-week moving average. As long as Target holds that rising 20-week moving average, I would expect a bullish outcome here and ultimately a breakout above 78.
Okay. Next one is Immunogenics, IMGN.
Yeah, this is in the biotech space, and it's one that's performed pretty well. I haven't looked at it last couple of days, but yet still holding up really well relative to a lot of the other biotechs that are out there. As far as key levels, I think price support is going to come in on any weakness, any further weakness. We almost got there. It looks like we didn't quite get there earlier this week, but close. We have some support that comes in at about $8. And earlier this week, we got down to $8.28. We bounced off of it, sitting at $8.84. But I like this move to the upside, sideways consolidation. We could draw another line right here. So after reaching a high, you can see this sideways consolidation for several months. Just recently broke out on expanding volume. So I think this one looks good. Pull back closer to $8 is a better reward to risk entry.
Okay. Let's see, number 7, JASO. And that is renewable energy, JA Solar.
Yeah, it's really had a difficult time trying to get through $8, and this goes back over a year. So I think if you, again, use this price support resistance line, you'll see right at about $8, all these multiple tests without it, being able to get through. Maybe off this downtrend, you could look at a left shoulder, neckline, head, right side of the neckline, and we're sitting in this right shoulder right now. A breakout above $8 on heavy volume, I think, would be very bullish. So that's what I'd look for here.
Okay. Let's see. Next one, NVIDIA. Always a popular one.
Yeah, and I think NVIDIA reports tonight. I think I saw that earlier. But let's take a look at the chart. Of course, it has a strong history with its earnings. But long term, I mean, it's hard to argue with this stock when you look at everything else. And this is a perfect example of what Greg was mentioning earlier in terms of relative strength. Look at the stock from the left side to the right side. It goes from 20 to 250. There aren't too many stocks that over the last 3 years can boast having gone up 12-fold. And really, that's over the last 3 years. I mean, 12-fold, maybe 2.5 years. So NVIDIA, I think, looks interesting. Now, when I say interesting, it's rising, breaking out the new highs, which is a good thing. But there is one warning in here, and that is there is a negative divergence on this weekly PMO, and has been in place for a while, by the way. So, they tell you this to me is a signal that we have a warning in play, but it doesn't necessarily mean we're going to go lower. So I think for those who are very risk sensitive, this is probably not a great trade or a stock to own. For those who are willing to take the risks, anytime you get a negative divergence like this on a weekly chart, I would be looking at the possibility of a test of the 50-week moving average. And you can see the last breakout here back in September, before we pulled back to the 20-week moving average. This was back at about the 165 area, maybe a little above, which is where that 50-day moving average is. 50-week moving average is. So I think with this negative divergence, if they don't report strong numbers, that's a long drop down to the 165 area when you're sitting at 222. But we've seen a lot of big drops in stocks when they don't perform and they don't come through. So I think there's a lot at stake here this afternoon for NVIDIA. I'm not trying to predict that the stock's going to drop 30%, by the way. I'm just saying that from a negative divergence perspective, it does have a lot of potential downside if they miss.
Okay. Let's see, the next one is ENBL, and that's in the energy space, I believe. Enable midstream.
All right, I'll go back into the dailies. Let's see here. Well, there was a really bearish candle at the top. Those of you who like to follow candlesticks, first of all, you can see that we tried to break through earlier resistance from September of 2017. And then right at the top, this is normally a pretty good signal. And the hardest thing to do sometimes in the market is to know when to sell. But when you see something like this, where you've got a clear breakout above previous highs, you're overbought, and then you come back down and reverse with a bearish engulfing candle like that, that is normally a good time to think about selling. We never went back up above that level, came back down to about the 1460 area. Now we're starting to march back up again. I just think for now we're in this sideways consolidation, and that would be 1420 to the downside. and $16 to the upside. So I'd be trading this within the range until it breaks above 16. And if it does break above 16, I want to see a close above it, and I want to see volume confirm it.
Okay. And our last one is APA, Apache.
All right, APA. Wow. Yeah, the energy stocks. When I looked at the various sectors earlier, when I was going through those perf charts showing all the sectors during high volatility periods over the last 10 years or so, I noticed that energy was the area that seems to be the one hardest hit for some reason. And that has certainly been the case over the past couple of weeks here. Apache is now all the way down, challenging what I think is a pretty significant level here on the daily chart. Let's pull up the weekly and just see. Yeah, I mean, we are down. Well, there's two key levels that I see going back the last 3 years. One was the low that we saw over the summer, right in here. And then we could go to the intra-week low, and you can see we're right on it as we speak. But volume, again, picking up. And this is just Thursday. This is a weekly chart, so the volume is going to be a little higher by the time tomorrow's close rolls around. But we've got the lowest close, weekly close, down at about 34 going back the last 3 years. And we're sitting right now at 37.95, testing this support. If we don't hold 38, I mean, if we move a little bit lower, let's call it 37.75 and close there, I don't really see any support until we get back down to around 34.
All right. That completes our 10 and 10 to 1. And we finished that pretty good.
Yeah, not bad.
Yeah, and here are the symbols. I will have them in the Market Watchers Live chart list after the show, as soon as Tom gets them to me. And we will have those. You can just go to the Market Watchers Live blog, and the chart list link is right at the top. So the blogs tab, Market Watchers Live blog, link right at the top. And with that, it's going to be time for a market update. So let me get that all ready to go. All righty. Oh, I love it when it just shares it right away. All right, so let's go ahead and look at our, actually, I want to make sure that this is all the way correct. There we go. All right, so what's been going on? Well, steady decline. The markets really haven't taken a pause at all today. Started lower and have continued lower. The Dow is down right now, reading at 24,225. We've got the S&P 500 also on a slide that hasn't really stopped much at all. NASDAQ, same. Russell 2000, everybody getting hit hard as the decline now begins to continue. TSX also in decline. We're not seeing good things there. I happen to know that the FTSE 100, I think, closed down over 1%. So that could have been weighing heavy as well. Treasury yields are down slightly, and we can see UUP is mostly unchanged. We also have commodities, which are lower, as well as USO, slightly lower, currently at 12.18. GLD, gold, is now rising. It had started the morning with a little bit of a decline, but has made some headway and looks like we might be forming a little bit of a flag there. The VIX is now rising. It started down a little bit this morning, but it is now rising, and we currently are reading at 33.59 for the VIX. We see declines are clearly leading advances at this point in time. Go really quickly, look at our market summary and see where our international ETFs are and our industry groups. There we go. Sector spiders, utilities, which of course we watch as a laggard all the time, is actually the only sector spider currently in the green. We can also see in the U.S. industry indexes, utilities are also leading there, and every other industry group is down, with paper and semis getting hit the hardest. Paper down almost 5.75%. Currently, all of our international ETFs, every single one of them that we're listing here, are moving lower. And the best one is Hong Kong, and it is down well over 0.5%, down 0.62 But you get to the third one, Russia, and we're already looking at 1.25% decline. So not looking very good internationally on these ETFs. And of course, you know, the US markets are probably affecting this to some degree. And with that, that concludes our final market update. And I'm going to hand it back to you, Tom, as I get my anatomy of a trade ready to go.
Okay. Let's see here. First thing I wanted to do is, and I started, you know, taking on some positions earlier this week when we had that first decline and then the bounce back. And there were a couple of reasons for it. So I'll just first go over and explain those before getting into any of the trades. But the first thing I noticed, and I wanted to point this out, this is the $ CPCE is the CBOE options equity put call ratio. So this is keeping track of equity only put calls. And any time that you've got a rising level, it's telling you that there's a lot more puts, equity puts being traded as opposed to calls. So when things get really bearish, you normally will see some huge spikes in the CPCE. Now, we saw a major spike last week, and earlier this week, we got up on the equity-only put-call ratio to about 0.77. And when you go back, that has kind of marked tops with two exceptions in 2017. You can see we haven't had too many closes on a daily basis up above 0.77. So that was just telling me that at least over the past, you know, couple of years, in this case, maybe a year and a half, anytime you get to that level, it starts to make you think that, okay, maybe this bearishness has gone a little bit too far and that perhaps it could be marking a particularly significant bottom. So that was one thing. The other thing, obviously, and we've been talking about this a ton, is the volatility index. Now, as Arthur mentioned, anytime you've got the volatility index higher, you have to anticipate that there is going to be extreme volatility. This is not business as usual. You know, I certainly don't expect that the market is just going to put all of this selling and all of this volatility behind it and just start, you know, slowly marching back up again. I don't think that's the environment that we're in now. We have to respect it for what it is. And that means there's going to be a lot of volatility. So if you're going to get into the stock market and you're going to create or take on new positions, I think there are a couple things that you have to consider. Number one, if the market goes against you, you are much more likely to lose bigger percentages if you're in individual stocks versus ETFs. So for me, and I don't usually trade ETFs, but this past couple of days when I got back in, I got into half positions and I got into mostly ETFs. So I think that's step one. Number two is you can also manage your risk by the size of your positions. So if you normally would buy, and let's just pull up the Spider, for instance. So with the Spider currently sitting at $262, if you normally would buy 50 shares, which is $13,000, maybe you want to think about buying 25 shares, which would be 6,500 or whatever, and working your way back in the event that the market continues to drop. If it goes higher, if it rallies quickly from here, you still have a position. I always refer to this as, you know, if the market goes up, you're half a genius. And if it goes down, you're half a genius. Now you can, I guess, look at that as being, you know, maybe half on the other side of the fence. But it just depends on how you're looking at it. I think that the most prudent way to approach the stock market in this kind of a volatile market, if you want to, you know, get involved, is you've got to do it in increments. I think just jumping in and saying I'm all in, I think is a mistake. I think that you know, obviously today the market is turning back around. It's going back down, looking like it might want to try to double bottom. So I think all of those things have to be in play when you're looking at a trade. So what I did is I actually did buy 4 different ETFs. So one being the Spider. And if I look at the hourly chart, what I did is I bought half a position on Tuesday on the recovery. As it was recovering, the VIX was falling off a cliff. And so I got in and I don't remember the exact number. I don't have it pulled up, but I'm going to say it was probably around 268-ish, because I did finish up that day. And of course, the next day looked pretty good. And then we went back down. But my strategy has been to get into half of it then. And if we do retest the bottom, to get into the other half. So technically for me, and this is a real trade, it's not a paper trade, but if it pulls back, if we see the spider back down close to that 260 level, and I think my order was at 260, even though we have an intraday low a little bit below, 260 would fill out my position. Now, I'm also trying to watch this weekly chart, because I would feel very bullish if we finish this week holding on to that rising 20-week moving average. So if the market doesn't go all the way back down, if we don't get that double bottom and we turn back around, and by tomorrow at the close, it appear to be closing above that 20-week moving average, I'm going to fill out my position. So it's going to be one or the other. I'm either going to get it on a double bottom, or I'm going to get it tomorrow if it is able to close back above the 20. Because I know that from looking back in the past, when you have a strong PPO, and we certainly had one here on the spider as we moved higher, if you pull back and you hit the rising 20-week moving average, and especially if you go below it intra-week and then come back up above it later that week, or if you go a little bit below it and then you come back up with a nice reversing candle the next week, it can be a signal that the worst of the selling is over. Maybe we consolidate, maybe we do have a quick bounce back up, who knows. But so I think the action, the rest of today and then also tomorrow, will dictate for me what I end up doing with the rest of my position on the spider. But here was a perfect example here where we went back down. We closed in, this would have been back in June of 2016. We closed a little bit below that rising 20-week moving average. But then the very next week, you can see that bullish engulfing candle that it then propelled us to higher prices. So those are some of the things that I'll be looking at as this trade unfolds. But I thought probably from a risk perspective, getting into something like the S&P 500 is a lot less risky than trying to trade an individual stock. If I'm wrong on the S&P 500, I'm going to lose a little. But if you're wrong on an individual stock in a market that's selling off hard, some of them can, really hit you pretty hard. So that was what I wanted to share for today. So I'll turn it back over to Aaron. And make sure you're unmuted.
Yeah, there are a few questions in the chat room you might want to take a peek at. And let me share my screen. So I'm going to talk about Tilly's, and it was interesting. Somebody brought that up in the chat room. And, well, that's not what I want. There. Forgive me. All right. So I wanted to look at my previous Monday setup and kind of go through the trade, because I had told people when I did it that I would have been stopped out and I wouldn't have had quite the loss that we ended up having on our Monday setups. I suspect that's probably true for you, Tom. So I wanted to go through this trade, and it's actually kind of an active trade right now. Yes, I actually have some money in Tilly's right now. So I should let you all know that. So this is January 29th when I picked this as our Monday setup, and we all know what happened after January 29th. Things got a little bit ugly. So let's see how this would have moved forward. So this is why it came up on the radar. I had the rising PMO for 3 days straight. I had a double bottom here, and I liked how it had come back. And during the trading day when I showed you this, it had actually pulled back off of that breakout, and that's what I was commenting on that I liked, because it was already doing its pullback in my estimation. So I got in on the Monday setup at 1424. I set my target at 1550, hoping for the best. And then I set a stop at about 1350, I think is what I set up in there. And it was just below that neckline. I didn't want to get stopped out too quickly. And I was feeling pretty good about the market at the time. So I wasn't too worried about setting a super tight stop at that point. So now I'm going to progress through time, as I like to do here. I think that's the second one. Is that the second one? No, let me get to this one. Okay. So right here, my stop ends up getting reached. Let me move forward here so we can see. I thought I had this set up on the right date. There we go. Okay. So my stop ended up getting reached, and I would have lost about 5% on that stop. I'm saying that I got at 1353 because I would have seen the intraday drop below, my stop, and would have probably, let's just say, will be on the side of that I got out at. I traded it after market close, so get out at 1353. So I did end up losing almost 5% on that particular trade. Not fun. And then I did see this topping PMO. So I left it on the radar, though, because I still liked the setup. I think that, it was really affected by what was going on in the market with that decline. So let's progress again through time. All righty. And that's the wrong one. All right. I'm on this one. I should have named them something a little different, so I wouldn't have been caught up here. So I'm going to actually go back just a bit here. I think it was on the 6th. Yes. Okay. So on February 6th, I would have re-entered. And the reason being, it had dropped down here. It had tested the support line, and then it had bounced up. And I thought that looked like a pretty good trade. So I'm back in at 1316. I ended up setting my target just a bit lower. I'd be very happy with $15, and I'll reevaluate when I get there. My stop I set right below, right on that support line, pretty much 1253. And let's see where we're going from here. And I believe that is the latest. All right, let's just move this forward now in time to today, and we'll see what we're doing. We're rising. So far, so good. But of course, today is a really difficult day. But overall, coming in off of that entry at 1316, I'm still ahead. So I'm liking the trade. I will stay in it, and I'll be watching it, pretty much every day. The best thing to do as far as stops go, and we always talk about whether it's a hard stop or a mental stop. I know, Tom, you're pretty much in agreement. Most of my stops are going to be mental stops. And the best way to get on top of those and know what happens is setting up a price alert on stock charts. Set up the alert to tell you when price gets to that certain level intraday that will give you that alarm bell if you don't happen to be at your computer looking at what's going on, and then you are alerted, and then you can go in and immediately evaluate what's going on with that trade. So I highly recommend you do that. Yeah, this one I just kept on my watch list. Normally I'd be looking for something else, but I just was very interested in this one. Felt that area of the market looked pretty good, and it just happened to still be in my watch list. So when I was kind of filtering through what was in there as a possible, pick up on this big decline in the hopes that we were ready to really have a good bounce, that's when I went in and looked, and it happened to be there. It looked pretty good, and so there you are. But yeah, this 2.83% loss doesn't look that great for me right now. But so that's an anatomy of a previous trade of the same stock and a reentry.
Yeah, I think the key too is making sure you keep your stops in play. I mean, that's where losses, which are unpleasant, can turn into very bad trades.
Yes.
Sometimes my best trades are a small loss. Because just getting out, number one, does two things. Number one, it kind of frees your mind, not to be worrying about and having that mental side of it, where your trade and the value of your portfolio is going down continually. So I think it certainly helps there, but it also gives you cash in your account when things settle down to be able to rationally get back into other trades. Because, and I know I did this many years ago, and it's why I don't even set up. Why I won't say I don't set up, but I rarely use margin because back in the day, and I'm talking about probably back in the early 2000 time frame, I do recall holding on to stocks way too long. I learned my lesson in the 2000 to 2002 bear market that when price support fails to hold, don't sit there and try to make excuses, but take your lumps and sit on the sidelines with your cash. And so that would be one of my biggest, one of my biggest pieces of, I don't want to say advice because we don't give advice, but a suggestion would be that you definitely consider, especially in a risky, highly volatile market like the one we're in right now, that you consider doing whatever you can to lower your risk, whether it's ETFs, whether it's smaller position sizes, maybe getting in incrementally. I normally don't get in incrementally. Normally when my stock hits my support level, I get in. Occasionally I'll get in, have 2 entry points, but usually it's just 1 entry point. So that's one big change that I'm taking right now, in that I am getting in over multiple entry points, and I'm using a number of ETFs as opposed to individual stocks. I rarely trade ETFs, and I don't get into the leveraged. I try to reduce risk, and I think those just increase your risk. You might think I'm not in margin, but if you're in if you're trading the SP 500 or the NASDAQ, and you're trading one of the, like the QLD, for instance, which is the leveraged ETF that tracks the NASDAQ 100. If you're in the QLD and you put your entire account balance in it, you really are 100% margin, because you're taking on a lot of additional risk. So anyhow, there is the recap of the anatomy of trade you can see on your screen. Aaron went over TLYS, and I just went over a very basic strategy on the S&P 500 ETF, the SPDR.
All righty. I'm going to just grab the screen just really quick before we go. Somebody was asking about the price alerts, and I wanted to show you how you can do that. All right, here's our homepage. Hopefully you can see that. And you want to go down to your scan. Actually, you won't see this bar unless you've gone up here, and make sure that you have scans and alerts. That's an easy way to get to what you want. So you just go down here to price alerts and new alert, symbol, email, or text message, or just get it on the website. Put your symbol in above or below a certain price, or you can always use this as a percentage. If it's going up 2% or it's 2% down, it'll alert you as well. So that's really the simple way to do it. So thought I would show everybody that.
Awesome. And we do have the ChartCon 2018 up there. I tell you, this was a fun show today because we did have both Greg and Arthur on with us. And it is always fun getting together with everybody. A lot of joking going on, a lot of laughing.
Mm-hmm.
We certainly have a lot in common because we all like to follow the market. We have our own styles and strategies and so forth. But getting together for ChartCon is, it's work, but it's also a lot of fun. And, so if anybody's interested, we've got the URL up there on the screen now. You can go in and check it out. You can certainly come out to Seattle with us and be a VIP. We have VIP packages where you can just come to the conference. Also, you can join us on a Alaskan cruise afterwards. I know a number of the featured presenters there will be going on the cruise. So anyway, it's a great opportunity to have some fun.
Yeah, and actually, I have to say, I loved just even me. I'm kind of a geek about all of this and hanging around all of these great names. But I can remember from the live ChartCon we did 2 years ago in 2016, I got to corner Bruce Frazier with a glass of wine, the two of us, and we talked all about kind of what I do, what he does. Your opportunities are boundless. We'll tell you if we're just sick of talking about the market, but let's face it, we're all just junkies. And so it's a great opportunity to go and, have a drink or just sit down with us, talk about your own stuff, what you're doing. And I think that would be invaluable, just that, for joining us live. at the ChartCon. But yeah, the registration for the online part is going to go on for a while, but the VIP registration is going to close next week. So think hard about it, and I really hope we'll see you.
Yep. And tomorrow, just a quick reminder for tomorrow, I will be doing a workshop. I'll just go through and show you some of my tips and tricks. I know on the survey response that we got a couple of days ago, I'd asked for some suggestions. And so I know one that came up fairly frequently was on the chart style button. So that's one of the things I'll go through and show you how you can set up those chart style buttons on the left part of your screen that you see Aaron and I click on a lot. You can save different styles and so forth. And I'll go through some other tips and tricks as well. So that'll be tomorrow. I hope you can join us. I do want to thank everybody for joining us today. It was great having Greg Schnell and Arthur Hill on with us. And please remember to complete that survey as you exit. We'd love to know what you thought of today's show, especially with Greg and Art on the show with us. As a reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Thursday afternoon, everybody. We'll see you back here on Friday. Happy trading.